Disclaimer.
Stop what you're doing right now. What happened on January 1st, 2026 changes everything we thought we knew about silver markets. This is not theory. This is not prediction. This is documented fact with transaction receipts and exchange data that Wall Street desperately hopes stays buried. Physical silver bars sold in Japan and the United Arab Emirates for $130 per ounce. The exact same day, the exact same metal, paper contracts on the Comex exchange in New York quoted $72. 80% difference, same ounce, same day. The largest decoupling between physical and paper in the entire history of precious metals trading just happened. And what I'm about to show you proves the paper market is finished. This isn't a small discrepancy we're talking about. According to data from the London Bullion Market Association, this represents the largest decoupling between physical and paper pricing in the entire history of precious metals trading. Bigger than anything that happened during the 1980 Hunt Brothers crisis. Bigger than the 2008 financial collapse. Bigger than the COVID supply chain disruptions of 2020. And if you're wondering whether this was just some brief glitch or anomaly, let me be crystal clear. This gap has been widening systematically for months, and the forces driving it are only accelerating. Here's what should grab our attention. While everyday Americans are being told that silver is trading around $70 to $80 based on futures prices, we see reported in financial media people with actual cash in hand trying to buy physical bars in Asian and Middle Eastern markets are paying almost double. You know what that tells us? The paper market, the system that's supposed to reflect the true price of this metal, is broken. When someone in Dubai has to pay 80% more than the Comex quote just to get their hands on real silver, that's not a market functioning properly. That's a market in the early stages of a structural collapse. Now, here's where this story gets really interesting. There is one institution that seems to have seen this coming long before the rest of us noticed anything was wrong. JPMorgan Chase, America's largest bank, made a move so dramatic between June and October of 2025 that it should have been front-page news. According to CFTC commitments of traders reports, JPMorgan held a massive short position of 200 million ounces in June. For those of you not familiar with trading terminology, being short means they were betting prices would fall. They were positioned to profit if silver crashed. But then something changed. By October 2025, the same bank had completely reversed course and accumulated a long position of 750 million ounces. They didn't just close out their short bets, they flipped to the complete opposite side and became one of the largest holders of silver positions on the planet. We're talking about a 550 million ounce swing in positioning in just 4 months. To put that in perspective, global silver mine production for an entire year is only around 800 million ounces. JPMorgan moved position equivalent to 70% of annual mining output in 16 weeks. You might be thinking, okay, banks change their positions all the time based on market conditions. That's true. But here's what makes this so explosive. This is the same JPMorgan that paid $920 million in fines to the Department of Justice and the Commodity Futures Trading Commission in 2020 for manipulating precious metals markets over nearly a decade. Federal prosecutors didn't just fine them, they convicted JPMorgan traders of racketeering, the same laws used against organized crime. The court documents showed these traders spoofed markets, placed fake orders to manipulate prices, and coordinated schemes to rig gold and silver trading. So when the very bank that got caught red-handed manipulating silver prices suddenly reverses from their largest short position to their largest long position in history, we should probably pay attention. This isn't some random hedge fund making a speculative bet. This is an institution with deep connections to the Federal Reserve, to the Treasury Department, to global central banking systems. And they're not just taking a modest position. They now control approximately 40% of all silver futures contracts on the Comex. Think about that concentration. 4 out of every 10 contracts are in the hands of one institution that previously manipulated these same markets. But JPMorgan's dramatic reversal is only one piece of this puzzle. On January 1st, 2026, the same day physical silver hit that shocking premium in overseas markets, China implemented export controls that fundamentally restructured the global silver supply chain. The Chinese government announced that refined silver exports would now require special licensing. And according to Reuters reporting, only 44 companies globally received approval to continue trading. These aren't small restrictions. We're talking about controls that effectively lock down 60 to 70% of the world's refined silver supply. Let me put that in context for you. China isn't just a player in silver refining. They're the dominant force. Between Chinese domestic production and their refining of imported raw materials, China processes more silver than the rest of the world combined. When they put export controls on refined metal, they're not just tweaking trade policy. They're fundamentally altering who has access to physical supply and under what conditions. The 44 companies that received licenses, They're predominantly Chinese state-owned enterprises and a handful of strategically chosen international partners. Now, you might be wondering if American business leaders noticed this shift. They absolutely did. Elon Musk, whose companies are among the largest industrial consumers of silver in the world for solar panels and electric vehicle components, posted on social media, warning that China's export restrictions were not good and that supply chain implications were more serious than people realize. When someone who needs millions of ounces of silver for manufacturing is publicly expressing concern, that should tell us this isn't some minor policy adjustment flying under the radar. Here's what connects all these pieces together. We have physical markets in Asia showing prices 80% higher than paper markets in New York. We have JPMorgan, the bank convicted of silver manipulation, reversing to the largest long position in their history. We have China choking off 60 to 70% of global refined supply to only approved buyers. And we have industrial users who actually need this metal starting to panic about whether they can source material at any price. What we're witnessing is the early stage of a supply crisis that's been building for years, finally reaching a breaking point. The paper market that has shown silver around $70 to $80 has been disconnected from the physical reality of tightening supply and surging industrial demand. And the smartest institutions, the ones with inside access to physical delivery data and vault inventories, have been positioning themselves ahead of what they know is coming. You know what should concern us most as Americans trying to protect our purchasing power and investments? The last time a major commodity market showed this kind of paper-physical decoupling, it ended with market manipulation scandals, regulatory interventions, and massive wealth transfers from those holding paper promises to those holding physical assets. The Hunt brothers tried to corner silver in 1980, and the Comex literally changed the rules mid-game to crush their position. But this time, the situation is reversed. This time, it's not speculators trying to squeeze the market. It's industrial demand colliding with restricted supply while major banks position on the long side instead of short. The 80% premium we're seeing in Asian physical markets today is not going to stay isolated in Japan and Dubai. Physical premiums don't respect geographic boundaries when supply is truly constrained. They spread. First slowly as traders arbitrage the differences, then rapidly as the market realizes the paper price no longer reflects reality. And when that realization hits, the paper holders are going to find out the hard way that a futures contract is not the same as a bar of metal sitting in a vault. So when you see mainstream financial media still quoting $70-something based on Comex futures, remember that someone in Tokyo trying to actually buy that same ounce is paying $130. And remember that JPMorgan, with all their connections and inside information, has placed a massive bet that the Tokyo price is closer to reality than the New York price. Because ultimately, in a physical shortage, the paper market doesn't set the price anymore. The people holding the actual metal do. Now let me show you exactly how we know this is real. Because anyone can make claims about markets breaking down. What matters is documentation. What matters is official exchange data that can't be disputed or dismissed as conspiracy theory. And what I'm about to walk you through is sourced directly from Comex delivery reports, CME Group regulatory filings, and Commodity Futures Trading Commission position data that's publicly available for anyone to verify. Here's what you need to understand about how the Comex silver market actually works. When traders buy futures contracts, the vast majority never intend to take physical delivery. They're speculating on price movements, and they close their positions before contracts expire. Industry estimates suggest that less than 1% of futures contracts typically result in actual metal changing hands. Most traders are perfectly happy settling in cash, taking their profit or loss, and moving on. The whole system is built on the assumption that paper trading vastly exceeds physical demand. But something extraordinary started happening in the January 2026 contract month. According to Comex delivery reports published by the CME Group, JPMorgan stood for maximum physical delivery on thousands of contracts. Let me translate what that means in plain English. Standing for delivery means they're demanding the actual silver bars, not cash settlement. They're saying we want the metal delivered to our vaults, and we want it now. When a major bank starts taking maximum delivery instead of rolling contracts forward or settling in cash, that tells us they believe physical metal is more valuable than the paper price suggests. The January 2026 delivery demand hit 65 million ounces across all participants. To put that in perspective, that's more than twice the typical monthly delivery volume we saw throughout 2024. The Comex registered vault inventory, which is the metal actually available for delivery, has been hovering around 70 to 80 million ounces total. Think about that math for a second. 1 month's delivery demand is approaching the entire available inventory in the exchange's vaults. That's not a healthy market with plenty of supply cushion. That's a market under severe physical stress. And here's where it gets even more interesting. Multiple sources in the precious metals dealer community have reported rumors circulating about the Comex potentially offering cash settlement options for January contracts. Now, officially, the exchange hasn't announced anything like that. But the fact that these rumors are even circulating among professionals who trade this market every day tells us something. It tells us that people with direct access to vault operations and delivery logistics are concerned about whether the exchange can actually fulfill all the physical delivery requests. You know what happened the last time a commodity exchange faced this kind of delivery pressure? In 1980, during the Hunt Brothers silver squeeze, the Comex literally changed the rules mid-game. They implemented Silver Rule 7, which restricted new long positions and effectively forced liquidation of existing positions. The exchange prioritized protecting itself in the shorts over honoring the contracts that long holders had purchased. Now, I am not saying the Comex is definitely going to declare force majeure or change the rules this time, but the historical precedent exists, and if physical demand continues exceeding available supply, exchanges have shown they're willing to intervene to prevent their own collapse. Now, let's talk about something that happened while most Americans were celebrating New Year's Eve and not paying attention to financial markets. On December 30th and 31st, 2025, the CME Group raised initial margin requirements for silver futures by 30%. Margin is basically the deposit you have to put up to hold a futures position. When the exchange raises margins, it forces traders to either deposit more cash or liquidate positions they can no longer afford to maintain. Here's what's so suspicious about this timing. The CME announced this margin increase during the holiday period, when trading volumes are at their lowest, when most institutional desks are closed, and when retail investors are focused on family celebrations rather than their trading accounts. According to CME regulatory filings, this was the largest single margin increase for silver in over 3 years, and it came just days before the January contract month when delivery demand was about to spike. Pop quiz. Who benefits most from a forced liquidation event caused by a surprise margin hike? The answer is anyone who's positioned to take delivery of physical metal at suppressed paper prices. When retail traders and smaller institutions get margin calls they can't meet, they have to sell their positions, regardless of where they think the market is headed. That selling pressure drives prices down temporarily, creating the perfect window for large players to accumulate or take delivery at artificially low prices before the physical shortage reasserts itself. This is exactly what happened during the Hunt Brothers crisis in 1980. The Comex raised margins multiple times, specifically to force liquidation of long positions. Federal regulators later investigated whether exchanges had coordinated with short sellers to engineer these margin increases at strategically advantageous times. Sound familiar? We're watching the same playbook run again, just with different players and slightly different timing. But here's what makes our current situation even more critical than 1980. Back then, the squeeze was driven by speculative positioning from the Hunt brothers trying to corner the market. Supply fundamentals were actually relatively balanced. Once the Comex broke their position, the market returned to equilibrium fairly quickly because industrial demand and mine supply were roughly matched. Today's situation is completely different, and we're facing genuine physical deficits that have nothing to do with speculation and everything to do with structural supply-demand imbalances. According to the Silver Institute's World Silver Survey data, we've now seen 5 consecutive years of supply deficits in the silver market. In 2025 alone, the deficit reached 230 million ounces. That means global demand exceeded new mine supply plus recycled metal by 230 million ounces. Where did that extra silver come from? It came from drawdowns of existing inventories, from government stockpiles being sold, from investors liquidating holdings. But those sources of supply aren't infinite. Eventually, you run out of inventory to draw down, and demand is only accelerating from here. The solar photovoltaic industry, which has become the single largest industrial consumer of silver, used approximately 290 million ounces in 2025. Industry projections from the Solar Energy Industries Association estimate that by 2030, solar demand alone will reach 450 million ounces annually. That's a 55% increase in just 5 years from one sector. Add in electric vehicles, 5G infrastructure, medical applications, electronics, and traditional uses like jewelry and coins, and you're looking at total demand that's structurally exceeding mine supply by larger margins every year. Now here's the number that should really grab your attention. According to cost analysis from primary silver mining companies, the all-in sustaining cost to produce an ounce of silver from major mining operations currently sits around $50 to $60 per ounce. That's what it costs to pull it out of the ground, refine it, and bring it to market when everything goes smoothly. But what about the solar industry's break-even price? What does it actually cost for a solar panel manufacturer to source the silver they need for production? Industry consultants who work directly with photovoltaic manufacturers estimate that when you factor in sourcing costs, supply chain logistics, hedging requirements, and the reality of constrained physical availability, solar producers need silver at around $134 per ounce to maintain profitable operations at scale. Let that sink in for a moment. The industry that is driving the largest and fastest growing source of silver demand needs the metal at $134. Meanwhile, paper contracts on the Comex are trading around $78 as I record this. That's not a small gap. That's 43% below the industrial break-even cost. Can you think of any other commodity that trades that far below what major consumers actually need to pay to secure supply? It doesn't make economic sense, and it can't persist indefinitely. One of two things has to happen. Either solar companies stop building panels because they can't source silver at economically viable prices, which seems unlikely given government mandates and climate policies around the world, or the price has to rise to meet the true cost of securing physical supply. Here's what that means for us as Americans, trying to understand where this market is heading. We have documented supply deficits that have drained inventories for 5 straight years. We have the largest industrial demand sector needing prices almost double the current paper quote. We have JPMorgan and other major institutions taking maximum physical delivery instead of rolling paper positions. We have the Comex raising margins during holidays to force liquidation ahead of delivery stress. And we have physical premiums in overseas markets already showing where true price discovery is happening when buyers demand actual metal instead of paper promises. Every single data point is pointing in the same direction. The paper price that we see quoted in financial media is artificially suppressed below the level required to incentivize new supply or satisfy legitimate industrial demand. And when paper prices diverge that dramatically from physical reality, eventually reality wins. Not through some dramatic crash or overnight event necessarily, but through a gradual then sudden recognition that the paper market no longer reflects the value of the underlying asset. The solar industry can't build their mandated capacity without silver. Electric vehicle manufacturers can't meet production targets without silver. Electronics companies can't make their products without silver. These aren't optional luxury uses. This is critical industrial demand that has to be satisfied regardless of price. And when 60 to 70% of global refined supply is now controlled through Chinese export licenses, the Western buyers competing for the remaining 30 to 40% of available supply are going to discover very quickly what true price discovery means in a physically constrained market. Now, let me show you the specific event that is about to trigger the next phase of this crisis and why the window to position ahead of it is measured in days, not months. Between January 8th and January 14th, 2026, the Bloomberg Commodity Index is conducting its quarterly rebalancing. For those of you not familiar with how commodity indices work, this is a scheduled adjustment where the index fund managers have to sell or buy futures contracts to maintain the target weightings of different commodities in the index. According to Bloomberg Index methodology documents, silver's weighting in the BCOM is being reduced by approximately 9% in this rebalancing. That might not sound like much, but when you're talking about an index that holds billions of dollars in commodity futures, 9% represents massive forced selling. Industry analysts estimate this rebalancing will require liquidation of over $6 billion in silver futures positions during that one-week window. These aren't discretionary trades based on market analysis. These are mandatory sells that have to execute regardless of price to maintain the index composition. Think about what that means for our market timing. We have a known scheduled forced liquidation event happening in the exact same month when physical delivery demand is spiking, when vault inventories are already stressed, and when China's export controls are choking off supply to Western buyers. The Bloomberg rebalancing is going to create downward pressure on paper prices, right? When the physical market is screaming that silver is worth far more than the futures, quote. That's not a problem. That's an opportunity. Here's what I need you to understand about this temporary dip that's coming. When index funds dump $6 billion in futures during a one-week rebalancing window, they're not making a fundamental assessment that silver is overvalued. They're mechanically executing required trades to match their index methodology. The selling pressure is artificial, time-limited, and completely disconnected from the underlying physical supply crisis. It's going to create the last realistic chance to acquire physical silver or well-positioned paper exposure before the market reprices to reflect physical reality. You want to know why I'm so confident this is the last window? Because the forces that are about to reassert themselves after this temporary selling pressure are not speculative. They're mathematical. Let me walk you through the calculation. China controls 60 to 70% of global refined silver supply and just implemented export licensing that restricts who can access that supply. Western industrial consumers still need their silver regardless of Chinese export policy. That means 30 to 40% of pre-existing supply has to satisfy 100% of Western demand. When you force buyers to compete for less than half the previous available supply, prices don't go up linearly. They go up exponentially because the last units of supply become exponentially more valuable to buyers who absolutely need them. A solar manufacturer who's already invested hundreds of millions in panel production facilities doesn't just shut down their plant because silver got expensive. They pay whatever it takes to secure supply because the alternative is complete write-off of their capital investment. Now add the fact that JPMorgan, HSBC, and Citigroup are all showing unusual accumulation patterns in CFTC positioning data. These three institutions alone now hold long positions representing over 1 billion ounces of silver futures. For context, total Comex registered inventory available for delivery is under 100 million ounces. The paper claims exceed physical supply by more than 10 to 1. That ratio used to be acceptable when everyone assumed delivery requests would stay below 1% of open interest. But when major banks start standing for maximum delivery instead of rolling contracts, that 10 to 1 ratio becomes a ticking time bomb. Here's the scenario that keeps Comex risk managers up at night. What happens if even 5% of paper longs decide they want physical delivery? 5% of open interest would be roughly 300 million ounces of delivery demand. The entire registered inventory is 80 million ounces. The exchange literally cannot fulfill that level of delivery requests with the metal they have in their vaults. At that point, they have three options. They can declare force majeure and cash settle contracts at the paper price. They can change the rules like they did in 1980 to restrict delivery demands, or they can allow the price to rise high enough that some longs decide to sell rather than take delivery. Let me give you the three price targets that matter based on different scenarios of how this plays out. The conservative target is $101 per ounce. That's the technical breakout level where silver clears major resistance on the charts and triggers momentum-based buying from trend-following funds. According to technical analysis from major commodity trading advisors, a confirmed break above $100 would likely trigger systematic buying programs that could quickly push prices to $120 or higher just from momentum alone. The industrial target is $134 per ounce. That's the break-even price the solar industry needs to maintain profitable operations at scale. When physical premiums force Western buyers to pay closer to true replacement cost rather than artificially suppressed paper prices, 134 becomes the natural equilibrium where supply and demand actually balance. At that price, some marginal industrial uses become uneconomical, demand destruction occurs, and recycling becomes more attractive. But all the critical industrial applications still get their metal. Then there's the squeeze target, $200 per ounce or higher. This is what happens if the Comex declares force majeure or implements cash settlement for a significant portion of contracts. When paper holders discover their contracts are being settled at $70 or $80, while physical metal trades for multiples of that, the credibility of the paper market evaporates overnight. Everyone who can take delivery starts demanding delivery. Everyone who can't take delivery starts buying physical through dealers at whatever premium necessary. And the price has to rise high enough to either incentivize holders to sell or ration the limited supply among desperate buyers. You want historical precedent for that scenario? In 1980, silver briefly touched $50 per ounce, which adjusted for inflation equals roughly $200 in today's money. And that was driven purely by speculative positioning from the Hunt brothers, not by genuine industrial shortages or supply restrictions. Our current situation has far more fundamental support for extreme prices because the shortage is real, the industrial demand is non-discretionary, and the supply restrictions from China are policy-driven rather than temporary market dynamics. Now let's talk about how this repricing spreads geographically. Right now, the physical premium is most visible in Asian markets. Japan and UAE showing $130, while Comex shows $78. But premiums don't stay isolated when arbitrage is possible. Traders with access to both markets will buy paper in New York and demand delivery, then sell physical in Tokyo for the premium. That arbitrage trade works until the Comex cannot fulfill delivery requests anymore or raises prices to eliminate the gap. According to precious metals dealers operating in multiple markets, premium spreads typically equilibrate within 60 to 90 days once arbitrage flows really start moving. We're already seeing premiums creep higher in London, which is the traditional bridge market between New York and Asia. The London Bullion Market Association has reported unusual tightness in physical availability, with delivery delays extending from the typical 2 to 3 days out to 2 weeks or more for large orders. That's your early warning signal that the physical shortage is spreading westward. Here's how the arbitrage collapse actually unfolds in practice. Right now, sophisticated trading firms are buying Comex futures at $78, standing for delivery, and then shipping that physical metal to Asia where they can sell it for $130. That's a $52 profit per ounce minus shipping and insurance costs. Sounds great, right? Except there's one fatal flaw in that strategy. It only works if the Comex actually has the metal to deliver when you stand for it. And based on the delivery data we're seeing, that assumption is becoming increasingly questionable. Think about what happens when a major trading firm stands for delivery on 10,000 contracts. That's 50 million ounces they're demanding. The Comex has to either deliver that metal from registered vaults or somehow convince the firm to accept cash settlement. But if the firm is planning to arbitrage the Asia premium, cash settlement at $78 doesn't help them. They need the actual metal to execute their trade. So the exchange faces a choice: default on delivery obligations or raid whatever physical inventory they can access to fulfill the request. Now multiply that scenario across multiple institutions, all trying to execute the same arbitrage trade simultaneously. JPMorgan wants physical, HSBC wants physical, Citi wants physical. Add in hedge funds, commodity trading advisors, and even some savvy retail traders who figured out this opportunity. Suddenly, you have delivery demands that far exceed what the vault system can provide. That's when the arbitrage breaks down permanently, because the source of cheap supply, Comex delivery, dries up completely. Within 3 months, I expect we'll see significant premiums appearing in North American physical markets. Not the extreme 80% gaps we're seeing in Asia right now, but premiums of 20 to 30% over Comex futures wouldn't surprise me at all. And once American industrial buyers and retail investors start experiencing those premiums firsthand, the psychological shift happens quickly. People stop trusting the paper price and start treating physical ownership as fundamentally more valuable. Let me give you a concrete example of what this means for regular Americans. Say you've been following silver for a while and you decide you want to buy some physical coins or bars. You check the spot price on your phone and see $78. Great. So you call your local coin dealer or check online retailers expecting to pay maybe $80 or $82 with a small premium for fabrication and dealer margin. Instead, they quote you $95 for silver eagles or $100 for kilobars. You ask why the premium is so high, and they explain they can't source new inventory at anywhere near spot price. Their wholesalers are paying huge premiums in the physical market, and those costs get passed down to retail buyers. That's already happening in some markets right now. American silver eagles, which are supposed to carry a modest $3 to $5 premium over spot, are trading with $10 to $15 premiums at major dealers. Why? Because the U.S. Mint can't get enough silver blanks to meet demand, and private mints are facing the same supply constraints. When you can't easily source physical metal to fabricate into coins and bars, premiums explode regardless of what the paper futures market says spot price should be. The institutional buyers face an even worse version of this problem. Imagine you're the procurement manager for a solar panel manufacturer. You need 5 million ounces of silver this quarter to keep your production lines running. You can't just walk into a coin shop and buy it retail. You need to source large bars from refiners or from the wholesale market. When you contact your suppliers, they tell you that Chinese export licenses are restricting their ability to source material, that delivery times have extended from 4 weeks to 12 weeks, and that prices are substantially above Comex quotes. What do? You pay the premium because shutting down your factory costs far more than overpaying for silver. This is why the industrial break-even price of $134 is so critical. That's not some arbitrary number. That's what real companies in the real economy are discovering they need to pay to secure reliable physical supply. And when enough industrial buyers are forced to pay that price, the paper market quote at $78 becomes increasingly irrelevant. The paper price might still print 78 on exchange screens, but nobody who actually needs physical metal can transact anywhere near that level. You want to know what really keeps me up at night about this situation? It's not just the supply deficit or the Chinese export controls or even the delivery stress at Comex. It is the fact that most investors and even many financial professionals still believe the paper price accurately reflects silver's value. They're making portfolio allocation decisions based on $78 silver when the physical market is screaming that real price discovery is happening 50 to 60% higher. When that gap closes, and it will close, the wealth transfer from paper holders to physical holders is going to be absolutely massive. Here's another angle most people aren't considering: the U.S. strategic stockpile of silver. We used to have a significant government stockpile, but according to the U.S. Geological Survey, those inventories were largely depleted years ago to help with supply shortfalls. We don't have a strategic reserve we can dump into the market to suppress prices like we do with oil. The Strategic Petroleum Reserve holds hundreds of millions of barrels that the government can release to moderate energy prices. We have no equivalent for silver. If prices spike due to physical shortage, our government has very limited tools to intervene. Here's what you need to understand as we head into this rebalancing week. The Bloomberg Index forced selling is going to create volatility and probably a temporary dip in futures prices. Mainstream financial media will likely report that silver is pulling back, that the rally is losing momentum, that technical indicators are weakening. None of that changes the underlying reality that physical supply is constrained, industrial demand is growing, and major institutions are positioned for much higher prices. This is not financial advice, and I'm not telling you what to do with your money, but I am telling you that the mathematical inevitability of this situation is becoming clearer by the day. When you restrict 70% of supply, when you have 5 years of deficits draining inventories, when industrial break-even is 43% above paper prices, and when the largest banks convicted of manipulating this market have flipped to maximum long positions, you don't need to be a genius to see where this is heading. The paper market served a useful purpose for decades. It provided liquidity, enabled hedging, allowed price discovery through trading volume that would be impossible in physical-only markets. But when paper claims exceed physical supply by 10 to 1, when delivery stress is forcing margin hikes and cash settlement rumors, when overseas premiums reach 80%, the paper market stops being a useful tool and becomes a dangerous illusion. What's happening right now in silver is the transition from paper-dominated pricing to physical-dominated pricing. That transition is never smooth, it's never orderly, and it never benefits the people holding paper promises when they realize those promises can't be fulfilled with actual metal. The only question is whether you position yourself on the right side of that transition while there's still time to act. Because once the premium spreads from Tokyo to New York, once the Comex announces delivery restrictions, once your local dealer is charging 30% over spot just to get coins in hand, the opportunity to position ahead of the crowd is gone. The setup is documented. The timeline is clear. The forces are mathematical. What you do with that information is up to you. But don't say nobody warned you when the market that traded paper promises at $78 suddenly reprices to match the physical reality that Tokyo already knows is worth $130. If you made it this far, you're part of the 1% who actually does their homework before the market forces everyone else to learn the hard way. Hit that subscribe button and drop a like so we can keep bringing you the intelligence that Wall Street hopes you never find. In markets like these, information is not just power. It's the difference between being positioned ahead of the wave and getting crushed by it.